Hello, and thank you for joining us today. My name is Hussein Adatia, and I'm a portfolio manager on Westwood's multi-asset team. I'd like to spend a few minutes today reviewing performance from November 2025 and also providing a brief outlook for the remainder of the year. From a high-level perspective, risk assets were mixed during the quarter, with the S&P rising 25 basis points, while the Nasdaq declined around 1.5%. During the month, concerns surrounding the sheer dollars being spent on AI and whether an adequate return could be achieved pushed investors away from the large tech names and into other areas of the market. Although the S&P 500 increased marginally during the month, the equal-weighted S&P 500 increased 1.9%, highlighting this phenomenon. Within the fixed income side, interest rates continue to decline as investors priced in another rate cut in 2025. Corporate spreads were relatively flat during the quarter, leaving investment grade and high yield yields at 4.75% and 6.6% respectively. Turning to the next slide, we are taking a deeper look at sector performance within the S&P 500. As noted earlier, technology underperformed, with the components returning negative 4.4%, while healthcare and communication services outperformed, returning 9.1% and 6.3% respectively. As questions regarding AI spend linger, many investors are reassessing overall exposure to the Mag 7 and increasing their allocations to lagging sectors including healthcare, energy, and financials. Next, digging in on fixed income, financials and utilities bonds continue their strong performance in 2025. From a rating standpoint, all classes of investment-grade bonds have had a solid year, returning well above 7%. Within high yield, BB bonds have done very well, returning 8.5%, as a combination of lower rates, tighter corporate spreads, and low corporate defaults has led to outperformance. Notably, lower quality high yield bonds have underperformed this year, with CCCs increasing only 5.6%, a rare occurrence with equities up nearly 18%. We would expect to generally see a more positive correlation here, but this year remains an outlier. And finally, to wrap up, a brief comment on the remainder of 2025. We expect the Fed to cut 25 basis points at their December meeting. The Fed is in a rare moment of dissonance as certain members are advocating for tighter monetary policy, given inflation remains stubbornly above the 2% target, and long-term budget deficits continue to push the long end of the curve higher. Elsewhere, the U.S. economy will get a boost in 2026 as benefits from the One Big Beautiful Bill and lower interest rates ripple through the economy. We expect corporate profits to remain healthy as AI productivity gains and industrial capex offset a modestly weaker consumer. For a more in-depth analysis of our economic views, please be on the lookout for our December 2025 Capital Markets Outlook, expected to be published shortly. Thank you for joining us today for the November 2025 market highlights. From our Westwood family, we would like to wish you and your family a very happy and prosperous 2026. Thank you.